Hi guys, Dmitry Bonder there. I don't want to pretend I know what will happen tomorrow and how severe the recession can be. But I can promise that in this video I gather a lot of facts and figures to help you make right decisions about coming recession and what you and I can do next. Okay, first things first. Now I know very well it was the worst first 4 months of the year for the stock market since 1970s. No, the 1930s. Can we just say it was a really bad start of the year? And bad might not do it justice. After dropping 3% this past week, the S&P 500 index has fallen 13% during the first 4 months of the year. It's the worst start since 1939. But the Dow Jones Industrial Average, after falling 2.5% for the week, has slumped 9.2% in 2022, its worst start since 2020. And not to be outdone, the Nasdaq Composite tumbled 3.9% during the week, putting it down 17% for the first months of the year. And that's its worst start to a year on record going back to 1971. And last Friday, the sell-off had gotten worse, and we were starting at the worst start to a year since the Great Depression. I'm not kidding, just poor facts. And I didn't want to pretend that I know what will happen next. My personal investment portfolio also dropped about 20% in the beginning of the year. But let's just check facts from the history, trying to find answers. Did it happen before? Looking back, there have been 25 4-month periods since 1992 when S&P 500 dropped 10% or more. And on first glance, they don't seem like the worst time to have put money to work. The index has gained a median 2.6% during the 6 months after these drops. That's understate both the potential risk and rewards. But 10 of these declines occurred from January 2000 through October 2002, the popping of the internet bubble, and just 4 were followed by gains over the following 6 months. Another 9 occurred at the beginning and at the end of the 2007-2009 financial crisis, with 5 followed by big gains. And there is a joke that you had to catch the end of the bear, not its beginning, to make money. But not every 4 months decline occurred during a recession or even resulted in a prolonged fall. In 1998, the S&P 500 fell 13% due to a Russian debt default that threatened to spill over into a global financial system, before rallying 29% over the next 6 months. The European debt crisis and the US debt ceiling showdown in 2010 and 2011 also caused double-digit declines that were followed by large gains. So my point isn't that the market will not keep falling. What I want to say that this past week's sell-off on what weren't terrible earnings is certainly disconcerting, and we don't need 1970s or 1930s comparisons to tell us that. For instance, Bank of America strategist Savita Subramanian say 1/3 of recession is already priced, given that the S&P 500 drops an average of 32% during bear market. But now the question is, what if recession will last years? While recession fears are spreading like a wildfire, it's also helpful to remember that not every recession as painful as the Great Depression. That was the biggest. And historically, there have been a total of 34 recession cycles since 1854, lasting an average of 17.5 months. And if you consider the period from 1945 to the present, the average length of a recession has been 11 months, which could signal that the recession are shrinking. As we saw in 2020, the economy rebounded relatively quickly, although it was a unique recession in that it came on a suddenly and was government-induced. Well, I hope I gave you enough historical facts. Now, as I promised, it's time to check what performs well during a recession and what I plan to do before the storm and what you can do. Of course, it's not investment advice, so stay tuned. Usually in time of troubles and recession, some stocks performs very well or better than others. First of all, utilities. Utilities are classic low-risk investment. Utilities are essentials and hopefully most people will not have to forgo them during a recession. For instance, household goods and other necessities are also considered a recession-friendly investment. I personally plan to add to my portfolio Williams companies, the natural gas infrastructure giant that operates critical pipelines that move gas and other energy commodities from production basins to market centers. You can find the same companies in your state. Another good choice for me could be a company with the name Waste Management. This waste collection and recycling company generally has steady revenue streams since demand for its services doesn't diminish much in recessions. What else is good? Health and basic consumer products. For instance, sample recession-proof stocks could be Johnson & Johnson. The iconic healthcare company makes very well-known products such as Band-Aids, Tylenol and some other that you definitely need in time recession or in time of the growth. Or for instance, United Health Group, very well diversified healthcare company. Or CVS Health, the health company that operates a leading drugstore chain, administers a large-scale pharmacy benefits program and provides health insurance to many people in US. Okay, now we are done with stocks. Gold. That's the most common safe haven asset of all time, gold. And gold tends to outperform stocks in times of economic turmoil. That's data shows. For example, during the Great Recession of 2008, the value of gold increased dramatically, surging 100% from 2008 to 2010, according to a report from Bureau of Labor Statistics. As a safe haven asset, a small allocation to gold could have a meaningful impact to overall portfolio volatility and performance for long-term investors who seek stability in a negative market environments and shocks to the capital markets. A fraction of my 401k portfolio would be allocated to dividend-paying stocks, because receiving a consistent flow of cash or stock payments can provide investors stability during an economic downturn. I have about 80% of my 401k allocated to dividend-paying stocks. Another option could be US Treasury bills, bonds or notes. They are among one of the safest investments since these assets are backed by the full face of US government, meaning it's a guarantee that you will get the full return on your investment as long as the investment is held until its maturity date. But I personally feel that it's a very boring asset with a low profitability, so maybe I'm not a big fan of it. And of course, last haven is a cash for buying the dip. If you're in the kind of financial stable position that allows you to buy in a downturn, you could be setting yourself up for success down the line by doing so. And since timing of the market perfectly is next to impossible, don't worry about trying to find the exact amount when stocks are in their lowest. Pick a few investments you have always wanted to own and give yourself a price threshold you feel comfortable with. Then just take some cash, put it aside, and when you will be comfortable with the price of this asset. What I also will do before start of recession, I will take care about my 401k asset allocation. I will switch my principal allocations into a more conservative allocation, for instance 30 stocks and 70 bonds, or it could be 20 stocks or 80 bonds. It doesn't matter, you should accept your own level of risk that you like. And if you're watching my video and you're very close to retirement, as a good rule of thumb, retired investors and those planning on retiring soon should keep 1 or 2 years of cash available in the case of recession. It's always wise to have an emergency fund and savings on hand. These funds are necessary for young investors, the middle age and the retirees.